Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now till the closing bell, and stocks whips on higher ahead of the close. Let's welcome in Jared Blickery, joining us to break down the headlines. Jared, what do you see?
Thank you, Josh. What a way to close the week, and I shouldn't get ahead of ourselves because we still got an hour to go. Dow is up 670 points or 1.5%, and you can see the swing today. We started getting bullish just before the noon hour, and we are pretty close to the highs of the day. NASDAQ composite up a very similar amount, very similar chart. You can see it was a little bit red earlier in the day. S&P 500 right there with it. So all the majors at 1.5%, but check out the S&P 500 equal weighted index. This is the best performance, 2.25%, that it has had in almost 6 months, I believe. And then you check out the small caps, the Russell 2000's up 3%. What is going on? I'll get to the bond market in a second. First, want to check in on the VIX Volatility Index. That has come down today, but only by 3 points. It's still at 23, not a level that I would have think is thought commensurate with the upside action that we're seeing in stocks today, but nevertheless, there you go. 10-year T-note yield down 4 basis points to 4.07%. 30-year down 2 basis points to 4.71%. And it's interesting. Here's the US dollar index. What's interesting about those yield drops is that a lot of interest rate sensitive sectors are leading today. I'm going to get into that in a minute. First, I want to give you the large cap sectors. Healthcare is leading up 2.5%, followed by consumer discretionary, materials, communication services, real estate. All of those up by more than 1.5%. Clearly, everything is in the green there. I'll quickly show you the NASDAQ 100, and you can see Alphabet up 4%, NVIDIA just up 0.4%, but a lot more green than red, and the semiconductor is really slamming today. Here's the Dow Transports. I'm going to skip over the industrials, just show you the transports, because this is another industry or sector where you're seeing a lot of outside performance, not Uber notably, but check this out. I'm going to show you the retail board, because this is one of the areas where we're seeing a lot of that outperformance today. Haven't seen some of these names light up like this in a while. Target's up almost 6%. Ross Stores up 8%, leading the S&P 500. And now finally, here is my leaders. These are my ETFs that I follow on a day-to-day basis to show me sentiment. Number one is home builders. Number two is regional banks. That tells me that this might be an interest rate move or sensitive move that we're taking a look at right here. Retail is third. That's XRT up 4%. Then you got small caps, biotech, disruption, gambling, transportation. Everything's in the green here except Bitcoin. Bitcoin cannot just cannot catch a bid. Bitcoin down about 3% over the trailing 24 hours, down to 84,000 and change. We'll be checking in all of this later, you and I, Josh. And looks like I got a couple more seconds here. So let me just show you what the regional banks are up to. And there we go. I haven't seen this in a while either, so it's just kind of a surprise coming after that big downside that we had yesterday. I'll throw one more thing at you. We do have options expiration today, so sometimes some hinky things are going on with that. Yesterday we had arguably some gamma selling by the options dealers, and I'm not going to get into that wonkiness right now, but suffice to say, this is a decent way to end the week, and I think the bulls will take it from here.
For sure. Jared, thank you. Well, NVIDIA shares popping on the back of a Bloomberg report that says U.S. officials are in early talks now around whether to allow NVIDIA to sell its H200 AI chips to China. Yahoo Finance tech editor Dan Howley is here. Dan.
Yeah, Josh, this would be huge if they were allowed to move forward with this move. This is not the highest end NVIDIA chip. This is the H200 based on the Hopper architecture. You recall right now, NVIDIA is shipping products based on the Blackwell architecture, their Blackwell and Blackwell Ultra, and then they'll have their Rubin architecture coming up after that. But this would allow them to start shipping higher end chips into China if this ever comes to fruition. It's not necessarily set in stone or anything. It seems as though, according to the report, they're just discussions. Right now, they're only allowed to ship the H20, which is a degraded version of the Hopper architecture, into China. And China isn't even taking those right now. This is all part of the ongoing back and forth between the two countries. Should the U.S. allow these kinds of high high-end chips to go into China. The Trump administration has seemingly been leaning towards that, having discussions with CEO Jensen Huang. NVIDIA has been pushing for this. They say that if they can ship their chips into China, it would give the U.S. a leg up because the Chinese developers would then be reliant on U.S. technology. Jensen Huang also says that nearly 50% of the world's AI developers are currently in China, and so it would behoove the U.S. to kind of take advantage of that. But there are those in Washington who say that giving the technology to China would ultimately be a bad thing for the U.S. because Chinese developers could potentially work with the Chinese military, and then that could give them a larger lead in AI or a lead in AI over the U.S. And so there's this constant back and forth and friction between whether or not they should ship or shouldn't ship, and if they do ship, what they would ship, whether it's the H20 or the higher end H200. Previously, we had heard talk about potentially Blackwell chips being shipped. That would be an even larger move than this.
Daniel, it's interesting because as you pointed out, the H200, right? It's not the latest and greatest. It's not Blackwell. It's sort of like if Trump, I feel like, like he told Tim Cook, he says, you know what, Tim, I'm feeling generous. I think I'll allow you to ship, the iPhone 14 to China. The iPhone 17, that stays here. The iPhone 14 can go. And I do kind of wonder, Dan, well, let's say this happened. How do you think the Chinese would respond and react if the H200 was permitted? I mean, how do you think Xi would feel about that? How do you think the Chinese companies would feel about that? And I guess what I'm really asking is how the H200, do we know how it compares and contrasts, for example, with Huawei, the performance gap?
Yeah, that's actually a good question. I don't know what that gap is like, although I will say that, when it comes to the Chinese government itself, they've been kind of telling companies to rely on homegrown chips, and they've been pushing for the likes of Huawei to make chips that are as capable as NVIDIA's. Now, that's not as easy said as done. We have AMD here, obviously globally, but it's a U.S. company, and they produce chips as well for AI data centers, but, they might not necessarily be up to snuff when it comes to what NVIDIA has to offer. And don't forget, NVIDIA also has its software, its CUDA software, which gives it a leg up as well. So, it's hard to say whether or not the homegrown chips in China would be able to catch up with NVIDIA. There's a reason why they're the leader in this space. They invested very early in this when nobody thought that there was any point in doing so, and it's paid dividends clearly from their revenue and a market share. But I think one of the things to think about is that with the H20 being a degraded version, there is the ability to kind of surpass that. The H200 is a higher end version chip, but again, it's not based on the Blackwell architecture, the latest architecture. So it's not really, a one for one when it comes to, getting the Blackwell and then getting this. This may not be exactly what, Xi Jinping wants.
Dan, thank you, sir. Appreciate it. Well, the big question for markets today is the December rate cut back on the table. Expectations for a cut jumping to around 70% from just 39% on Thursday. That's according to the CME Fed Watch tool. This is coming after New York Fed President John Williams said he believes another interest rate reduction, quote, in the near term could be warranted. Yahoo Finance Fed correspondent Jennifer Schonberger is tracking where members are stacking up for a cut next month. Jen.
Hey there, Josh. Yeah, New York Fed President John Williams really reset expectations for a rate cut in December when he said in a speech earlier today that there is, quote, room for a rate cut in the near term. And this was significant for two reasons. One, because this came a day after we saw that stronger than expected rebound in September payrolls, which had many thinking that perhaps a rate cut was no longer on the table. And second, because Williams is part of the so-called troika, the leadership at the Federal Reserve, along with Fed Chair Powell and Vice Chair Philip Jefferson. Now, he is the head of the New York Fed, who also serves as the vice chairman of the Federal Open Market Committee. Now, on the back of his comments this morning and others' comments, I am tracking where all of the 12 voting members land right now ahead of the Fed's next policy meeting, which, believe it or not, is just 2.5 weeks away. So I have four categories that I've created separated. And the first is those who are leaning towards a cut. And I am putting Williams in that bucket today. I also put Jefferson in that bucket because he had a speech earlier this week in which he didn't come out and say he supported a rate cut, but he said that he sees risks to the downside for the job side of the Fed's dual mandate. He's more worried about that now than inflation. Now, my second cluster is those who are outright in favor of a cut. And we know there are 3 Federal Reserve governors there, Fed Governors Waller, Bowman, and Myron. And Waller said earlier this week, no matter what happens with the September jobs report, he's voting for a cut. So we know he's a slam dunk. We heard from Myron earlier today, who said, yes, he's for a 50 basis point rate cut, but if he was the marginal vote, he would vote in favor of 25 basis points. We also know that Fed Governor Bowman has penciled in 3 cuts this year, and she's concerned about what she calls increasing fragility of the job market. So that's bucket 2. Third is the unclear bucket, if you will, and that's where I have Chair Powell, Lisa Cook, and Fed Governor Barr. Cook generally votes along with Powell. We don't know which direction Powell is leaning in right now. And Barr, he seems a little bit more worried about inflation, but I couldn't see him dissenting if the rest of the committee was in favor of a cut. And then lastly, I have those hawks who seem to be against a cut, and that includes the regional Fed Bank presidents Collins, Goolsbee of Chicago, Schmid of the Kansas City Fed, and Alberto Musalem of St. Louis. And we heard again from Susan Collins this morning, who seems disinclined towards a rate cut for next month, for December. She seems to be taking signal from contacts on the ground who say that they're more concerned about inflation. She thinks that underlying demand resilience in this economy is also surprising for her. And this is after she gave a speech earlier this month in which she had said, look, I think we could hold rates here for some time, end quote. Goolsbee has also said on our air he's concerned about inflation moving in the wrong direction, specifically the services component of inflation as opposed to goods inflation, perhaps from tariffs, which could be a one-time increase in pricing. And then we have Schmid and Musalem. Schmid, of course, dissented against a rate cut last meeting because he thinks that there's underlying demand in the economy is quite strong. And by cutting rates, he thinks that the Fed could ignite inflation. So I don't expect that position to change for him either. Josh?
Great roundup. Thank you, Jen. Appreciate it. Well, joining me now is Jeff Roach, LPL Financial Chief Economist. Jeff, great to see you. Let's stick with the Fed there, all right? So we had this line from New York Fed President John Williams, respected guy, sees room for a further adjustment in the near term to the target range. I think investors seem to appreciate the near-term part there, Jeff. You saw that headline. Make sense of it for us. Next month, what's your expectation? They cut. Should they cut, Jeff?
Yeah, well, so what they're going to do, what they should do. For the last several months, I've been in the opinion that they do go ahead and cut in December. They continue that rate cutting campaign in 2026.
Which is interesting, Jeff. I only interrupt you to say, we hear some of our central bankers, you listen, they've been coming out and saying, well, inflation, 2%, it's a target, it's not a suggestion.
Well, there are conflicting signals, no doubt. And I think that's what makes it so confusing and really volatile for markets. I think going back just a little bit in terms of why the Fed is talking the way they do, it's because of a phrase Bernanke used, and I don't know why it didn't catch on in social media, but he talks about open mouth operations. And Ben Bernanke was basically saying, hey, they can make a soft pitch to markets by their speeches, right? Before the blackout period, as we know, the several weeks before the next decision, they're not allowed to make headlines like we had this morning. But before the blackout period, they're there to communicate what their thoughts are and what they're thinking about the risks between inflation and between unemployment. And it's this open mouth operations, which I think it's a very clever way to say it. I think at this point, you think about the hard data, the conference board data, the jobs hard to get, the difference between plentiful, hard to get, the survey data on employment from NFIB, from ISM. There are a number of surveys that suggest the labor market is weakening. We had a little bit of surprise with September's numbers, but I think in the way I look at it is you look at the 3-month moving average. Don't look at these month-to-month changes. They're too volatile. The fact that we've had so much downward revision in June, July, and even before that, those downward revisions in my mind suggest that the labor market is cooling. It's not cratering, it's cooling. It's not necessarily recessionary signals, but it's one of those things where you say, okay, if we know that's the case, that's eventually going to roll into the lower aggregate demand, which is eventually going to pull that pressure off the services inflation that some.
Can I ask you though, Jeff? Let's say
about.
if the concern is a cooling labor market, and let's say they do 25 next month, what kind of impact does that actually have on the labor market?
The impact will be on businesses and those businesses that are more sensitive to rates, and then it'll have an impact on part of the consumer base that are more sensitive to rates. And I think you frame the whole thing with what we've been talking about, the K-shaped economy. I think it's a very helpful way to explain
Meaning
it.
low-income consumers challenge high-income consumers doing better.
You have two very different economies. You have one economy that's not as rate sensitive. So in some way you could argue, will a rate cut impact them? Well, not as much. They're just less rate sensitive. That's your more affluent categories that aren't tapping the credit markets like that lower leg of the K. If you go back to that K analogy. So I think it is fair that the lowering the rates will impact the economy most under pressure right now. But it's a risk, right? Because you lower the rates, there's still problems in the housing market, there's an undersupply there, there's pressures in some areas of the credit markets, higher delinquency rates, for example, again with your lower income households. So it is certainly a risk because the signals are not very clear. What's more important to deal with, the inflation side or the employment side?
You know what's interesting about the K-shaped economy? I feel like my entire adult life, I've heard about a K-shaped economy. Do we talk about, is it getting more K-shaped?
That's a great question.
Yeah.
I think COVID certainly created that, the haves and have-nots. I moved from California to North Carolina in 2021. Saved a lot, right? Millions of Americans did that. So the K-shape was accentuated, to your point about, hey, how long has this K-shape been around? COVID experiment certainly, really dialed that in and exposed it. But perhaps it's fair to say post-Great Financial Crisis, I was in this business before the crisis, been around a while. So perhaps the 2012, 2013 era when rates were extremely low, right? We created a problem when there was an undersupply in housing. Perhaps that K was around, but not as accentuated since COVID. Great. That's a great question, though.
Jeff, great to have you, especially on set. Thank you, sir.
Appreciate it.
Coming up, we zero in on the turbulent week in markets. Don't go anywhere. Well, the market rebound gained steam here as expectations for a rate cut in December jump. Still, all three major averages on track for weekly losses, with November as a whole set to be the worst month for stocks since 2008 as AI bubble fears remain persistent. Joining me now to break this all down, we got Scott Ladner, Horizon Chief Investment Officer. Scott, great to see you as always. Let's just start big picture, Scott, with these markets. Green across the screen. It's been a roller coaster. I got the Dow up. It's up more than 600 right now. Scott, help me make sense of this. How do you explain it?
Look, this week, Josh, has been, frankly, a little bit confusing for a lot of folks. I mean, we got really good data kind of across the board, both from companies, like individual companies like Walmart and NVIDIA. We got, a pretty solid, frankly, employment report. And so, all the data looked pretty good. The price action, obviously, has been horrific outside of today. And so, to us, this is speaking a lot towards, frankly, a lot of P&L protection from hedge funds. Guys have had reasonable years this year. They don't want to take a lot of risk. We're seeing that sort of kind of show up in liquidity metrics that are pretty poor right now, and a lot of technical selling coming out of systematic strategies like CTAs, vol trading guys, that kind of thing. So this is kind of a classic, good data, bad price action week, which can be a little bit disconcerting for investors and for folks. But at the end of the day, it's not really changing the medium term story for anything. We have a lot of tailwinds in this market.
Well, that's what I'm going to ask you. I mean, if the explanation, Scott, is okay, year-end P&L, poor liquidity, I guess how long do you expect those sort of technical factors to overwhelm the fundamentals?
Look, so it looks like we're probably coming towards the end of a lot of this technical selling. It's going to take a lot of volatility out of the S&P 500 or out of equity markets in general to keep the pace of selling going that we've got. It could basically keep the pressure on. The other thing that we need to see though is frankly in that 2022 Scott Ladner would have scoffed at this, but if we don't get stability out of Bitcoin, if we don't get stability out of some of the crypto space, it's also going to be probably hard to really kind of catch a meaningful bid in risk assets, broadly speaking. And so, this is probably a couple of conditions we got to get met. We got to get Bitcoin to at least stabilize, and we got to have some of this sort of systematic selling pressure come off. We do think we're probably 7th or 8th inning of the systematic selling side, though.
On Bitcoin, Scott, how do you explain the selling there? I guess one, and two, do you see any signs or signals that hey, we could be bottoming?
Look, anybody that can tell you that they can explain price movements of something like Bitcoin is probably spinning a bit of a yarn. But what we do know is that there's a pretty important level around $77,000 in Bitcoin, which is essentially like the pre-election, or I'm sorry, the sort of the election day kind of highs and also the April lows. That's marked sort of a couple of pretty important pivots in the price of Bitcoin. And if you're looking at Bitcoin, you have to look at technicals. There's no fundamental value to it or sort of like pricing model to ascribe sort of a value to Bitcoin. So you really got to look at technical levels, and that 77,000 number is pretty important. If we hold it, and we got close to testing it overnight, if we hold that, then we could get a little bit of a relief rally off of this. But frankly, we're just going to need to see positive price momentum start to take hold in that market, and that's really what's going to end up turning it. Just the standard more buyers than sellers thing.
Scott, so let's look a little farther out, 6-12 months. You sounded more constructive. What are the tailwinds exactly, Scott, you see?
Yeah, Josh, we are really constructive out 6 to 12 months. I mean, this is still a story where we have something like AI, which is people have been likening AI to the internet and PC revolution of the mid to late 90s. I think that's reasonable. But I think actually probably a more apt comparison though is when basically the widespread adoption of electricity in somewhere like the United States. I mean, we think it's that important to the economy in terms of productivity gaining things. So so you have that as sort of like the massive tailwind that is going to kind of power everything else. But then you have other things that are at the back as well. I mean, you have an incredibly constructive earnings picture. We're just through earnings season now, and we get 16% year-over-year EPS growth, 8% year-over-year revenue growth. Those are really great results. You're going to get fiscal stimulus both from the government with respect to the big beautiful bill stuff, and on the private sector with respect to capex. I mean, you can look at capex spending for powering AI and basically building AI out as basically a private sector stimulus package. So you put all that stuff together, and you got a consumer that is still fine, a labor market that is not dynamic and not robust, but it's certainly stable right now, and that paints a pretty nice picture for corporate earnings and for the stock market going forward.
Scott, on that AI trade you bring up, though, that NVIDIA print, that was a strong print, it was a strong guide, and the stock sold off, Scott. And I'm just wondering what you think that might suggest to us as investors about the AI trade. Is it just feeling a bit tired here in the near term, Scott? What is going on there?
Yeah, Josh, that is the most concerning and the most kind of goofy price action we saw this week, and that got everybody's attention. It has to get your attention. And stock just blows numbers out of the water. Guidance is really good. Jensen was great on the call. Saying kind of all the right things. Providing sort of reasonable guidance as to kind of the demand picture going forward. And the stock gaps open, and then you just summarily gets killed throughout the day. I mean, that bearish reversal got everybody's attention. It got everybody talking. And it definitely led the way down, over the last couple of days. But at the end of the day, this is still a story which ends up making some sense. And so, what we make out of this price action, what we make out of the NVIDIA stock reaction specifically, is that the position wasn't clean enough. There were still too many guys out there that were too long this name or too long this theme coming into what has been a challenging year, but a decent year for people. And they're just trying to protect profits. I mean, we think it's really that simple stupid, in terms of what, but like the price action explaining NVIDIA post number.
Let's end here, Scott. Bring it all together. What do I want to overweight? What do I want to avoid? Give me some ideas.
Look, we are. I hope I don't regret saying this, but there are a couple of things that we think are pretty interesting here as we come into next year. One of them is actually equal weight S&P 500. The equal weight, or I'm not going small caps yet, but equal weight. The average stock basically in the S&P 500 relative to the Mag 7, relative to the top of the market, we think is going to actually catch a bid as we come into next year, because we're getting broadening of earnings pictures. Like, this is not just the Mag 7 at the top of the market carrying the water for the entire index, and with respect to earnings and with respect to fundamentals. Like, the average stock is starting to perform on a company earnings level basis. So we actually think that broadening out trade could get some legs as we come into next year. And if you really want to get a little bit spicy on that, you could even go into something like financials. And financials are kind of a classic early cyclical play. We think we're due for a cyclical rebound as we come into next year. Coordinated global growth boom, kind of emanating from global central bank, cutting, plus basically government and private fiscal stimulus packages coming into next year. If you get that sort of early growth boom, financials are probably the place to be as well.
Scott, always great to have you. Have a great weekend, sir.
Thanks, Josh. Appreciate it.
All right, now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joins me here for a look at Wynn Resorts, Fast Casual, and Elastic. We're going to start with Wynn Resorts. Citi setting a bullish tone on the stock with a buy rating. That stock has enjoyed a nice move here, Brooke. It's up about 40% this year. Is it too late to get in, Brooke? I'll tell you what the street thinks. They don't think so.
Not yet.
About 90% of analysts who cover this one think you should buy it. Zero sells on Wynn.
Yes, certainly. They think that there's a long road to more momentum ahead, and that's what we're hearing across the street. Why? Because this company sits in the spot that a lot of folks on the street like right now, and that is the premium, the high income earner. That's exactly where they sit. That's what this note in Citi. They said that the premium operator in the casino area, which carries its own organic benefits in an unpredictable consumer environment, and that's why we're seeing this momentum, behind the stock year to date, is that it's been able to sort of figure off all those headwinds that have been up against the consumer because people continue to go there. They continue to spend their money. The note also pointed out that there's lots of inorganic growth potential that they bring to the table with that Project Horizon coming in UAE region. Also, they said that brand strength, it continues to be a strong contender for any opportunities beyond that. And they said that cash flow generation and balance sheet health to enter a capital return phase starting in 2027 and 2028. And so certainly more room to run, apparently, for the stock heading into the next few years.
Yeah, look at that bounce off that April low. All right, turn to fast casual restaurants. Those stocks sizzling in today's trade as investors dip into this sector. This is your world, Brooke.
Yeah,
fast casual.
We've been talking about this, Josh, and this
Lots to
certainly
discuss.
has me excited today because these are the companies that have been doing really poorly, especially as all three of them, Cava, Sweetgreen, Chipotle, they all reported their earnings just a few weeks ago. They really hinted that younger Gen Z consumer has been pulling back. And now, as we're seeing, what was a broader sell-off, now a stronger rebound in the market, these companies are winning today. We have Cava seeing its best day since April 9th. That stock is up nearly 14%. We also have Chipotle up about 5% today and Sweetgreen up 12%. These are the first time that these companies are seeing momentum in quite some time, as the fast casual sector hasn't seen quite the same run that it saw last year.
And finally, let's end here on shares of Elastic because they're under some pressure following its quarterly results that appear to have been disappointing for Wall Street among that AI momentum. So software company, I see analysts at Bloomberg Intelligence weighing in. They say results raise questions, Brooke, around its ability to capitalize on the favorable observability backdrop with AI momentum yet to drive meaningful acceleration amid deals slipping, they say, in Q3. They add that Datadog and Dynatrace continue to post stronger top-line growth.
Yeah, and keep in mind, this has not been a favorite on the street. Year to date, this stock is down more than 27% over the past year, down 23%. But we are hearing some optimism on the street, including from Wedbush. Wedbush does have an outperform rating on the stock. The analyst there, keep in mind, this is Dan Ives, a big bull when it comes to AI. He said that while this quarter was a speed bump to the Elastic growth story, we believe the company is in the early innings of its long-term growth story as it continues to invest strategically to capture more share of the AI market. Of course, keep in mind, Dan Ives is a major bull when it comes to this AI momentum that we've been seeing in the market. But taking a step back, the stock definitely, sort of taking on the chin. I guess that's the right way to say it today. Sure. Down nearly 13% and down 27% year to date.
All right, thank you, Brooke. Appreciate it.
Of course.
Coming up, we get a check on the auto space. That's coming up next on Market Domination. Tesla shares went on a roller coaster ride this week following the fluctuations in AI worries. For more on what's driving the share price action, let's get to Yahoo Finance's Pras Subramanian. Pras.
Yeah, battling those AI headwinds, right? We saw earlier this week NVIDIA popping there, but then all of a sudden rolling over in the Tesla. They're connected to AI efforts with their robotaxis and self-driving, and that's sort of connected to that world, and the stock took a hit yesterday. But today they're rebounding along with the broader market here. But aside from that, you also had some good news for Tesla from the robotaxi front, right? So earlier today, BI reported that in Nevada, they completed a self-certification process to operate robotaxis in the state with safety drivers, but also not commercially yet, but you can still do it there. And then also in Arizona earlier this week, they got the same thing. They had completed a final step to get that robotaxi service going. So you have two more possible locations going online with the robotaxis with safety drivers, mind you, because they haven't achieved level 4 yet like Waymo has. So that's pretty good, and then if they can improve that, then you kind of can prove the AI, physical AI sort of test that they've been doing. And earlier this week, Stephen Gengaro was bullish on upgraded the stock price target here. So there is sentiment improving, but it's all connected to the broader Mag 7 trade, and then if that gets knocked, then Tesla's going to go down too.
All right, so that's Tesla. Let's talk about another automaker, Ford, which is popping here today. What's going on with that one?
Yeah, so Ford actually took a hit yesterday because of the fact that there was another fire at that aluminum processing plant in Oswego, New York, called the Novelis plant there. Now they put out a statement just today or this afternoon saying that they reaffirmed their guidance because that fire actually was put out and the plant is back to operating, sending out parts. Reaffirmed the guidance, adjusted EBIT of $6 to $6.5 billion and adjusted free cash flow of $2 to $3 billion for the full year. So they're saying, hey, everything's good. We're going to be on track. We're going to make up some of the lost production that happened in the earlier fire in early 2026. So they're saying all good here. So the stock rebounded today, but basically it's flat over the last 2 days.
Finally, let's switch gears. I want to talk about critical piece in many of the industries you cover, rare earths. What's the headline?
Yeah, hard-hitting piece by me in today's Yahoo Finance early morning edition. But basically, rare earth elements is what they're called, REEs, right? The important material that's in not just stuff like batteries, but also in wind turbines and electric motor parts, jet fighter parts. You need these. They're heavy and light, different types of metals elements. You need them both. The problem is China's dominated the market, not just in the light, but the more important heavy elements. They have basically all of the materials and the processing. So what's happening now is we're seeing more ex-China sources coming online to do that. One company called Brazilian Rare Earths, who I spoke to the CEO about, he was in New York visiting recently, spoke to him about what they're up to, and they have a big kind of reserve down in Brazil. What they're saying is that when this comes online in 2028, we're having the highest sort of purity with regards to, or the grades with regards to both heavy and heavy and light elements. So there's a lot of bullish sentiment there. The stock is up 80% this year, something crazy like that.
Wow.
But
yeah, look at that chart.
But it takes years to develop these sites and years to get the processing in order. So it's a long-term bet. But what's happening is, we've seen U.S. companies take stakes in companies like MX Materials. They bought a stake in that. So we're seeing not just countries, but companies, everyone trying to get ex-China resources.
And investors moving in. Thank you, Pras. Appreciate it. Well, Gap raising its full-year forecast after topping third quarter expectations. The retailer getting a boost from its Better in Denim campaign, with comparable sales up 5% year over year. And Yahoo Finance executive editor Brian Sozzi spoke to Gap Inc. CEO Richard Dixon about the results.
Look, I think it's clear our strategy is working, and it's showing up in the momentum of the business, and we're seeing it in results. To your point, we've had consecutive quarters of consistent positive comps. This is our seventh consecutive quarter. We were up 5%, net sales up 3% over last year. Our brands are performing. Old Navy delivered an outstanding quarter. It's our largest brand. It was up 6%. Gap up 7%, and that's on top of 3% from last year. It's eighth consecutive quarter. Banana Republic up 4%, second quarter in a row on comp, gross margin exceeding expectations. So look, we are incredibly proud of our performance. The playbook is working, and with another share of gains, our brands are winning where it counts, and that's with the consumer.
Help us understand what you're seeing from a consumer standpoint, Richard. This week we have Walmart saying lower income and higher income people are coming to its stores for food that is higher priced. TJX, of course, Marshalls and Home Goods, they had a good quarter too as well. How are they, where are they getting this money, Richard? They can't afford to shop at all these places.
It comes down to a few really important aspects: product, storytelling, execution. We're seeing great strength in our customer behavior. We're winning with all income cohorts, and you can see it with the differentiation in our portfolio. We see equal growth across low, middle, and high, and this is evidenced by the two biggest brands in our portfolio, Old Navy and Gap. We do see external data points that suggest there's macro pressure on the low-income consumer, but our customers are finding our price, our value, our style, our quality, our narratives, our store experiences. They're breaking through the competitive landscape. We've had less discounting, better regular price sell-through. We've increased our average unit retail. That's indicating that our product is resonating. We're also excited to see the high-income consumer discovering our fashion, quality, and value, and we attribute this to the narrative that we're putting out there in the context of cultural relevance and marketing. Our portfolio appeals to a wide range of consumers, and it gives the Gap Inc. portfolio great flexibility in today's environment. We have a stronger portfolio today than we have in the past. brands are resonating with consumers, and we're looking forward to a strong finish to the year.
Is the reality that styles, Richard, have just changed at some point this year pretty markedly? Wider leg pants, how things fit and feel are a lot different, that people just do not or did not have this stuff in their closet?
People always want fashion and to be on trend and relevant. And I think today, when you look at our brands and compared to where we were in the past, we've always been a reliable place for basics. And now what you start to see is we've sort of surround sounded it with great fit, function, feature, innovation. The product presentations look really strong. Our denim collections across our brands, but of course, particularly Gap, has been outstanding. Fleece. We've gotten really innovative with different fabrications, bounce fleece, various different ways that we've expressed innovation, and even sleepwear. You know, Gap is driving a sleep to street concept that is working incredibly well. Customers are always looking for style, but most importantly, quality and value, and clearly our brands have it all.
When you first took over this job, Richard, I thought, and I told you this, I thought you were going to close hundreds and hundreds of stores. Now, I would say you have prune stores. But you mentioned this in the earnings call last night regarding the Gap division, that you are at a pivotal moment for the store base there. What does that mean, and what is next for the store base for Gap?
Stores are incredibly important to us, but what we really think about is our consumers, where they are, where they're going, whether it's in stores or through a digital dialogue. And we're focused on cultivating what I would say is the best experience across every touch point that our consumers are in. So when we look at our fleet today, we have a very strong fleet of about 2,500 doors. We are at a pivotal point. We have been pruning and optimizing our retail footprint. We're now in a precision point where we're looking at new concepts, new doors, refreshed models, and we believe that it's going to be an exciting chapter. We're always optimizing our retail footprint. We're always looking at repositioning, in some cases, on locations that we believe are more relevant to our customers. We're evaluating new store openings. And last year, I think we closed about 56 stores across our portfolio. We probably have another 35 this year. And now we're at a really exciting point where we believe we've got some incredible opportunity for growth from a store perspective, and certainly our online business has been performing very well.
You said something very interesting also on the earnings call last night, Richard, that I haven't heard from you before. You said you are in the final stages of fixing the fundamentals. Then what will define Gap's 2026?
Yeah, Brian, well, you've been on the journey with us. We defined what we call our transformation roadmap in 3 phases. The first phase was fixing the fundamentals. And fixing the fundamentals is really about our strategic priorities, financial and operational rigor, just running the business better. Reinvigorating our brands with our playbook that's starting to generate cultural conversation and traffic to our stores and our sites. Strengthening our platform, supply chain, tech, HR, legal, finance, and energizing our culture. As we finalize, if you will, these stages of fixing the fundamentals, and the metrics are proving that we've done that, and we still continue to work on that model as continuous improvement, we now move on to the next phase, which is about building momentum. We've got the momentum now in our brands and our portfolio, and now we're going to continuously improve to drive consistency in that deliverable, getting to our third phase, which is accelerating growth. So while we're in this building momentum phase, which is about continuous improvement, we're seeding high potential opportunities that will enable us to accelerate growth for the long term, including high margin, traffic, driving categories like beauty and accessories, and lots of new concepts that we're working on behind the scenes, but a very comprehensive, phased approach. We're entering that build momentum phase with a lot of energy and a culture that's really excited about what we can do with it.
Lastly, Richard, how will you spend your Black Friday? And are Black Friday and Cyber Monday, are these still needle-moving days for a company like Gap?
Absolutely. They're really important days. And by the way, every day leading up to it is an important day in retail. We're off to a great start. I will be in stores. My leadership team will be in stores. We'll be active with our customers and experiencing that firsthand. We've got a lot of exciting activations that are planned for the holiday season, even more exciting releases that will come soon. I'm really excited about certain categories. Denim continues, fleece, sleepwear, marketing is fantastic. Brian, go online. I know you do. Our brands look fantastic. Products are great. And ultimately, we're there for our customer. I don't know if you recently saw Old Navy did a partnership with DoorDash, which again is really a thoughtful consideration, recognizing we want to be everywhere our consumer is. And it provides convenience for tens of millions of users. Stores are ready, teams are ready, we're ready. We look forward to a strong finish.
Coming up, an analyst lays out his winners and losers in the retail space. Stay tuned. The price-conscious consumer creating a tale of two retail worlds. While some retailers are full steam ahead on growth, others are getting swept up in the current and falling behind. Let's get straight into it with Zacks Investment Management Senior Client Portfolio Manager, Brian Mulberry. Brian, great to see you as always. Let's get right into these names, Brian. What you like here? Walmart, you say, Brian. Clear winner this week. What was the big important data point or points, Brian, as you read through that earnings report that really stuck out to you?
Yeah, the e-commerce segment that they've invested a lot in over the last year is really paying off. It was up 27%, almost to the point where they mentioned on the earnings call they're now attracting even more affluent customers. So they're not only just growing in traffic, they're growing wallet share from more of the wealthier consumers that they want to interact with. And that's them using online sales to compete directly with Amazon, home delivery, making it easier to interact. And they're really doing a great job with that e-commerce division.
As they attract those more affluent customers, Brian, I'm curious, what do you think the impact is on the financials long term? You know, what could it mean for revenue mix, for competitive positioning?
It adds a lot of sustainability to revenue growth because these more affluent consumers aren't just buying groceries or generic diapers and things of that nature. They get into the more of the apparel and the hard goods, and they like to act in that manner with their wallet. And so that leads to not just revenue growth, but a sustainable form of revenue growth in higher margin items and products. And that's really what's exciting about the near-term growth for Walmart going forward.
You like the new CEO, Brian? John Furner, right guy for the job?
Yeah, insider. He knows all the culture. He understands the direction that they're trying to achieve. So now it just comes down to execution. Think he's the right guy for the job.
Let's talk about another name here. Home Depot. You talk about what you say, Brian, is a trampoline effect on revenues when housing activity rebounds. Explain that, the trampoline effect.
Well, they've been able, again, to grow their average ticket size pretty. Traffic was down. We've had some really good weather across the country, a lack of storms, and so foot traffic was down, but the customers that are still shopping at Home Depot are spending more and more. So as they continue to capture that wallet share, once we have an event where traffic picks back up, the average ticket sales plus more foot traffic is that trampoline bounce that you're looking for in terms of revenues going forward. So our Home Depot has really done a good job of providing more options to home remodelers. If they're looking for really fine accoutrements when it comes to their bathroom and kitchens, you can always find that. But now they also have custom landscaping that's available. So whenever we see rates come down more, maybe one or two more rate cuts, we could actually start to see another wave of refinancing home sales. We really do think that could increase traffic over the next couple of quarters in a meaningful way, and you get that bounce in revenue as well.
How would you say, Brian, that Home Depot's positioning compares and contrasts with Lowe's in a housing market recovery?
You know, I think they've done a better job of creating a really strong network of design and contractors that help you complete a project. They're just much more advanced in that pro segment where you can walk in and say, hey, this is the vision I have for my house, whether it's refinishing my basement or my backyard. They can sit down, help you design what an outcome should look like, and then connect you with the professional contractors to get it done. Or they could even teach you right there on the spot how to do it yourself if that's really what you're motivated to do. And that's just seamless from store to store, region to region. You can find that type of access at any Home Depots. Lowe's isn't quite as consistent, and they don't have quite the same bullpen of customized products that consumers are looking for.
Brian, what about TJX? You say a trifecta of positives. What is the trifecta here?
Yeah, they're just absolutely killing it. They're attracting more customers as people are starting to look for better values as they're spending their dollars, and they don't have to worry about paying for tariffs once you walk into a TJ Maxx or a home goods type of store. They're just simply rebuying products that have already landed on the shore, meaning somebody else somewhere paid those tariffs for you. You don't have to worry about it there. So there's some consistency in terms of the deep discounts on brand names that you're looking for. And again, it's all about that wallet share today. You're seeing more customers spend more money per transaction in their stores. So those are the three key pillars there for TJX.
All right, TJX, what's your take on Kohl's as well and what you see there now and ahead, Brian? Just looking, not a ton of love on the street for this one. I see just two buys here, Brian.
Yeah, they're just struggling. You talk about tariff exposure, it's right smack dab in the middle of Kohl's face. They just can't find a way to onshore the goods and maintain their margins. They're still well known for having sales. They do the Kohl's Cash. They now have partnered with Capital One in terms of their Kohl's card, but we're starting to see those transactions go down. We're starting to see delinquencies increase on the Kohl's card, and they're just having a hard time maintaining the margins on the inventory. So they've got to find a better way to address the profitability of their business model going forward.
Finally, Brian, I just want to end quickly here on Target. And there you emphasize that Target is struggling to connect with its customer base. What is the core issue there, Brian, in your opinion? Is it merchandising? Is it branding?
I think it's kind of all of the above. You know, Target spent 30 years trying not to be Kmart. They wanted to engage with a higher class of customer. They wanted to attract people and have them buy higher priced goods, whether it was apparel for themselves or home goods for decorations. And they did a really good job of that until we got hit by COVID. And they had this issue where they had to deal with excess inventory and they had to make a decision. Do we blow it out or do we save it for the next seasonally correct cycle? And the problem is they end up having the biggest blue light special ever, and they turned into Kmart. So they had an 80% clearance sale, and they changed the customer base. Now the customers 5 years later are still waiting for the next clearance sale. They're not engaging with what's happening in the stores, and the stores have fallen into a little bit of disarray. They're not as clean or as well kept as they once were. So they're just having a hard time reconnecting with what was once a very loyal customer base.
Brian, appreciate your time and those picks. Thank you, sir.
Thank you.
Well, wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.